What if I told you that investing just $1 could be the foundation of your entire early retirement strategy? Most people think you need thousands to start dividend investing, but there's a completely different approach that the wealthy have been using quietly for decades. Today, I'm breaking down the exact blueprint that transforms single dollars into a retirement machine and why this strategy is so powerful that almost nobody talks about it publicly. By the end of this video, you'll have a step-by-step plan that could completely change your financial future. Sarah Martinez started with exactly $1 in 2012. Not $100, not $1,000. One single dollar. Today, 11 years later, that dollar has grown into a portfolio generating over $4,000 per month in passive dividend income. She retired from her corporate job at 38 years old, and it all started with understanding a concept that 99% of investors completely ignore. The financial industry wants you to believe you need massive amounts of capital to build wealth through dividends. They push expensive mutual funds with high fees and tell you to wait decades for results. But Sarah discovered what I call the dollar dominant strategy, and it's based on a mathematical principle that compounds so aggressively, it literally breaks the traditional rules of dividend investing. Before I reveal the exact blueprint Sarah used, if you're serious about achieving financial independence through dividend investing, you need to subscribe to this channel right now. I break down strategies like this every single week, giving you the exact blueprints that most financial advisors will never share. Hit that subscribe button, because everything I'm about to show you builds on concepts I teach throughout this channel. This isn't just about making money, this is about buying back your freedom. And here's the thing that's going to shock you most about Sarah's story. The $1 strategy doesn't just work with dividend stocks. There's a hidden component to this blueprint that most people never discover. And when I show you what it is later in this video, you'll understand why the wealthy have kept this approach so quiet for so long. Let me start by destroying the biggest myth in dividend investing. Everyone thinks you need large amounts of money to generate meaningful passive income. This myth exists because most people think linearly about money. They see a stock paying 4% annually and think they need $25,000 invested to generate $1,000 per year. That's old school thinking. Sarah understood something different. She understood that the real power isn't in the amount you invest initially. It's in the frequency and the compounding velocity. The $1 strategy works because it exploits three mathematical advantages that large investments actually can't access. But here's where most people get this completely wrong, and it's costing them decades of potential wealth building. The first advantage is what I call micro DCA, or dollar cost averaging, at the smallest possible scale. When Sarah started, she wasn't trying to time the market or find the perfect entry point. She was investing $1 every single day into dividend-paying assets. Not weekly, not monthly, daily. This frequency creates a smoothing effect that's mathematically impossible to achieve with larger, less frequent investments. Let me show you exactly how this works with real numbers. Traditional advice says invest $500 monthly into a dividend fund, yielding 4%. Over 1 year, you're investing $6,000. But with daily $1 investments, you're also investing roughly $365 annually. But you're capturing price fluctuations that monthly investors completely miss. And this is the part that's going to blow your mind about how compound math actually works. When you invest daily, you're buying more shares when prices are down and fewer shares when prices are up. But you're doing it at such a granular level that your average cost basis becomes incredibly stable. Sarah's first-year cost basis on her core holding was actually 12% lower than what she would have achieved with monthly investments of $30. But the real magic happens in year 2 and beyond. This is where the dollar dominance strategy reveals its true power. Sarah didn't just continue her daily $1 investments. She took every single dividend payment, no matter how small, and immediately reinvested it the same day she received it. Most dividend investors wait until they accumulate enough dividends to make what feels like a meaningful reinvestment. They might wait until they have $50 or $100 in dividend payments before buying more shares. This delay is killing their compound growth. Here's the exact number that changes everything, and you'll understand why Sarah's results were so extraordinary. In her third year, Sarah was receiving an average of $2.47 in daily dividend payments across her portfolio. Instead of letting this money sit in cash, she was reinvesting it immediately. This meant her daily investment had grown from $1 to $3.47, but her lifestyle expenses remained exactly the same because the extra money was coming from dividends, not her salary. By year 5, her daily reinvestment had grown to $8.32. By year 7, it was $19.15 per day. The acceleration becomes exponential because you're reinvesting compound growth back into assets that produce more compound growth. But there's a hidden component to Sarah's strategy that most people never discover, and it's the real reason this approach works so well. Sarah wasn't just buying dividend stocks, she was using what I call the three-bucket system. Bucket 1 was high-yield dividend stocks with yields between 6 and 8%. Bucket 2 was dividend growth stocks with yields between 2 and 4%, but consistent annual increases. Bucket 3 was what she called her secret weapon bucket, and this is where the magic really happened. The secret weapon bucket wasn't stocks at all. It was dividend-paying real estate investment trusts, business development companies, and closed-end funds trading at discounts to their net asset value. These assets often yield between 8 and 12%, and they're specifically designed to distribute cash flow to investors monthly rather than quarterly. And here's why this changes everything about how fast your money compounds. When you're receiving monthly distributions instead of quarterly dividends, your reinvestment frequency quadruples. Sarah was receiving dividend payments 365 days per year from her combined portfolio instead of the typical 91 days per year that most dividend investors experience. This frequency difference alone increased her compound annual growth rate by approximately 2.3%. Let me break down her exact allocation, because this is crucial for understanding why the $1 strategy works so effectively. 20% went into Bucket 1, the high-yield dividend stocks. 40% went into Bucket 2, the dividend growth stocks. And 40% went into Bucket 3, the secret weapon assets with monthly distributions. This allocation meant Sarah was receiving some form of dividend payment nearly every single day, and she was reinvesting that payment the same day she received it. The velocity of her compound growth was unlike anything traditional dividend investing can achieve. Now, you might be thinking, this sounds incredible, but there has to be a catch. And you're absolutely right. There is a catch, and it's something that could completely derail this entire strategy if you don't understand how to handle it properly. What I'm about to tell you is the reason why most people who try this approach fail miserably, and it has nothing to do with market performance or dividend cuts. The catch is psychological, not mathematical. When you're investing $1 per day and reinvesting tiny dividend payments, your account balance grows very slowly in the beginning. Most people get discouraged and quit before the exponential acceleration begins. They see their balance at $200 after 8 months and think the strategy isn't working. Sarah almost quit in month 14. Her total portfolio value was only $412, and she was questioning whether daily $1 investments were worth the effort. But she understood something that separates successful dividend investors from everyone else. She knew that compound growth is invisible until it becomes unstoppable. And this is where the strategy reveals its true genius, but only if you stick with it long enough to reach what I call the dividend tipping point. The dividend tipping point happens when your daily dividend income exceeds your daily investment contribution. For Sarah, this happened in month 26 when she was receiving $1.08 in daily dividends while still contributing her original $1 per day. From that moment forward, her portfolio growth accelerated exponentially because she was essentially getting free leverage from her own dividend income. By year 4, Sarah's daily dividend income was $3.92, while her personal contribution remained $1. She was now investing $4.92 daily, but only $1 was coming from her salary. The other $3.92 was her money making more money without any additional effort from her. This is why I call it the dollar dominant strategy. You start with complete control over just $1, but that dollar begins dominating and controlling larger and larger amounts of capital through systematic reinvestment of dividend payments. But here's the part that makes this strategy absolutely unstoppable once you understand how to optimize it. Sarah didn't just reinvest her dividends randomly, she used what I call strategic bucket rebalancing. Every time she accumulated $50 in dividend payments from any bucket, she would analyze which bucket was underperforming and redirect those dividends accordingly. If her high-yield bucket was underperforming due to market conditions, she would temporarily redirect dividend payments from her other buckets to buy more shares of undervalued high-yield stocks. If her dividend growth stocks were having a strong year, she might temporarily redirect payments to accumulate more shares at favorable prices. This rebalancing strategy meant her portfolio was constantly optimizing itself based on market conditions and relative value opportunities. She wasn't just passively collecting dividends, she was actively managing the reinvestment process to maximize long-term wealth accumulation. And this brings us to the most powerful aspect of the entire strategy, something that could accelerate your timeline to financial independence by decades. Once Sarah reached year 7, when her daily dividend income had grown to $19.15, she made a critical decision that transformed her trajectory. Instead of continuing to invest just $1 of her own money daily, she increased her personal contribution to match her dividend income. This meant she was now investing $38.30 daily, $19.15 from dividends, and $19.15 from her increased personal contribution. Her total daily investment had grown by 3,730% from her original $1, but her lifestyle inflation had only increased her daily investment by $18.15. The acceleration from this point forward was extraordinary. Within 18 months, her daily dividend income had grown to $47.83. By the time she reached her 10th year, she was receiving over $93 in daily dividend payments, generating more passive income per day than most people earn per hour at their jobs. Here's the exact moment Sarah knew she had achieved financial independence, and it's a number that will probably surprise you. In month 127, Sarah's monthly dividend income reached $4,367. Her monthly living expenses were $3,250. She was generating over $1,000 more per month in passive income than she needed to maintain her lifestyle, and her portfolio was still growing exponentially through continued reinvestment. She made the decision to retire from her corporate job and focus full-time on optimizing her dividend portfolio. Today, she manages her investments as a full-time activity, constantly researching new opportunities and optimizing her three-bucket allocation based on market conditions. But here's what makes Sarah's story so powerful. She didn't start with any special knowledge or insider advantages. She didn't have a finance degree or decades of investment experience. She simply understood that consistency and compound growth are more powerful than any individual stock pick or market timing strategy. The dollar dominant strategy works because it harnesses the mathematical certainty of compound growth, while minimizing the psychological barriers that cause most investors to quit before achieving meaningful results. Starting with $1 removes the fear and hesitation that prevent people from taking action. It creates a habit that becomes automatic and unstoppable over time. And if you're wondering whether this strategy still works today, with current market conditions and dividend yields, the answer is absolutely yes, but there's one critical adjustment you need to make. Today's market offers even more opportunities for the dollar-dominant strategy than when Sarah started. The proliferation of fractional share investing means you can buy portions of expensive dividend stocks with single-dollar investments. Exchange-traded funds focused on dividend growth offer instant diversification for small investments. And online brokers have eliminated most transaction fees that used to make small investments uneconomical. The critical adjustment is understanding that today's yields are generally lower than they were in 2012, but dividend growth rates have remained strong. This means you might need to weight your allocation more heavily toward the dividend growth bucket and be more patient with the initial accumulation phase. The mathematical principles remain exactly the same. Daily investments, immediate reinvestment of all dividend payments, strategic rebalancing between asset categories, and increasing personal contributions as dividend income grows. These principles worked in 2012, they work today, And they'll work 20 years from now because they're based on mathematical certainties, not market predictions. The dollar dominant strategy gives you the mechanical framework for building wealth through dividend investing, but success ultimately depends on developing the right mindset and psychological approach. Most people who attempt strategies like this fail, not because the math doesn't work, but because they don't understand the mental game of long-term wealth building. That's exactly why you need to watch my video called The Psychology of Dividend Investors Who Escape the Rat Race. Next, it reveals the specific mindset shifts that separate investors who achieve financial independence from those who quit too early. You can find it right there on your screen, and it's the perfect follow-up to everything we've covered here today. If this video has shown you a path to financial independence that you never considered before, make sure you're subscribed to this channel because I break down strategies like this every single week. This isn't just about making money. This is about buying back your freedom and creating the life you actually want to live. The dollar dominant strategy is your blueprint. Now you just need to take action and start building your dividend empire, $1 at a time.